Peter, thanks for being with us today.
Sure. Thanks for having me with you.
And Peter, you're known for your bearish views on the U.S. economy and the U.S. dollar. You're known for your bullish views for foreign currencies and commodities. Tell us about your thesis in your latest book, which is The Coming Bankruptcy of America.
Well, it's actually titled The Real Crash, America's Coming Bankruptcy. And the reason that it's called The Real Crash is because I also wrote a book in 2006 that forecasts an economic crash. And most people think that it was the 2008 financial crisis. And while my earlier book did forecast that crisis pretty much exactly the way it unfolded and for the reasons why, but in that book, I still looked at the 2008 incident as the precursor to a much larger economic event. That's the crash that I was really worried about. So I diagnosed the disease in the U.S. economy, but I said that what would ultimately kill the economy was not that disease, but what I believed the government cure was going to be. We were going to die from the cure, and unfortunately, the government has provided the exact toxic medicine that I thought it would. And as a result, the real crash is still looming, and that's what I'm helping to prepare investors for.
How do investors prepare for this?
Well, I think the epicenter of the real crash is going to be the U.S. dollar. And so I think that investors that certainly own bonds denominated in U.S. dollars, and we have a gigantic bubble in the U.S. bond market, but the real losses might not simply be interest rates rising and bond prices coming down, but the value of the dollar going down, so that people who are buying bonds and lending dollars, when they get repaid their dollars in the future, they're not going to buy very much. And that is the principal risk. I think that stocks represent a much smaller risk in that respect. But I do believe that there are a lot of risks in the U.S. stock market relative to other markets around the world. So I think that if people want to hedge themselves against inflation and a weak U.S. dollar, the U.S. stock market is not the best place to do that. There are other stock markets. And again, I don't necessarily just buy stock markets. I buy individual companies rather than just buying entire markets, because I find much better value if you can be selective and if you understand how various companies around the world are going to be impacted from the economic crisis that's going to hit the United States.
What are some of these other markets that you like? What countries?
Well, I generally like countries that have more in common with what America used to be than what America is today. You know, America used to be the freest country in the world. We had limited government. We didn't have a lot of regulation or a lot of taxes. And today we're really the opposite of that. There are other countries that come closer to what we used to be than what we are today. So I find the countries that have more freedom, more opportunity, less government, more economic growth, better monetary policy, better fiscal policies, better trade balances. And some examples are Singapore, Hong Kong, New Zealand, Switzerland, and there are a number of countries that we do invest in around the world that are in much better shape than the U.S.
In your latest book, what is the timing that you predict on this coming bankruptcy of America?
Well, it's not really so much of a timing. I mean, I do think that it's inevitable, and it's not that the bankruptcy of America. I mean, America is already technically bankrupt. I mean, we owe more money than we can possibly repay. We just haven't defaulted yet. So it's not about America going broke. We're already broke. It's about our creditors acknowledging that fact and administering some kind of a solution on their own, some kind of externally driven crisis, kind of like Greece. I mean, Greece was bankrupt for a long time. It's just nobody wanted to admit it. And there are still people that don't want to admit it. But, I mean, the facts are the facts. And people who loan Greece money are going to have to take haircuts on those loans. And the Greeks are going to experience a diminishment in their standard of living. The same fate awaits the United States. The question is, when are people going to come to terms with the situation? And it very well could happen in 2015, but more likely it'll happen in a later year, maybe 2016, maybe 2017. I don't know exactly, but we are certainly headed for that awakening, and people need to be prepared in advance because you can't do it after the fact. The only way to prepare for a crisis is to be too early.
What are you talk about buying stocks in foreign countries. You mentioned Singapore, Hong Kong. You didn't mention Canada, but I know you do some work up there. Other than sort of investing in these foreign economies, what should people be doing? Where should they be investing?
Well, I think that one of the problems that's, being experienced around the world, not just the United States, but countries are pursuing inflationary monetary policy. Central banks are keeping interest rates too low. That's a universal thing right now. So monetary policy is too loose. Interest rates are too low. And so you are having a push for inflation, which really represents a transfer of purchasing power from creditors to debtors. So you don't want to be a creditor. You don't want to own bonds and clip coupons in this kind of environment. You need to own real assets, tangible assets, real plant and equipment, real resources, and you want to have income streams that are tied to those businesses where the prices can go up as money is debased. So you don't have a fixed coupon that you're collecting and then you've got a bunch of money that's a set quantity that's waiting for you in 5 years, 10 years, or 20 years. You want to own real things. So I want to own real businesses. Real estate, I think residential real estate in most, certainly of the English-speaking world, is very expensive. But, industrial properties, commercial properties, you can find much better valuations there. And, of course, we have exposure to these sectors through property trusts, similar to a U.S. real estate investment trust. There are good ways to get exposure to international real estate, especially now with the dollar being so overvalued based on a speculative bet that I think is a bad bet, and I think the speculators who've been buying dollars are going to get burned when they wake up to reality. But the dollar's been bid up based on the false idea that the U.S. economy is experiencing a real recovery and that the Fed is going to raise rates. I think we're experiencing a bubble, and the Fed is going to do QE4 to try to get some more air into it and keep it from popping. But in the meantime, that means foreign assets are on sale. And if you happen to be an American and you've got dollars, or even if you're a foreigner and you've got dollars, spend them, get rid of them, use them to acquire international assets, including real estate, that is on sale right now because of the overvalued dollar. It's better than just taking a vacation in Europe because that's just a good deal on a hotel room. Buy assets abroad that are going to give you income streams that will be far more valuable after the dollar crashes.
Peter, you run a gold fund. You haven't mentioned gold. Talk to me about your view on gold.
Yeah, well, we own a lot of mining stocks for clients. We do manage a gold-oriented mutual fund, Europe Pacific Gold Fund. I have a family of 7 mutual funds, and that one is specific to gold miners. I think gold prices have been forming a bottom over the past couple of years, just around 1,200. I mean, every time it's been below 1,200, it's, gets bought back. We're right now about, I don't know, 1,220 or something like that. But there's some major support down here. We began the gold bull market in around 1999, 2000. We had 12 years in a row of increases. We've been digesting those gains the last couple of years. I think we're forming a base with which the next leg of the bull market is going to run. Meantime, I think the gold stocks are incredible bargains. I think there's a lot of negativity on the part of mainstream Wall Street investors. Are very skeptical of gold. They think gold's a bubble. They expect gold prices to fall. They've already priced that negativity into the gold market, gold stock market. So gold stocks are priced for a gold crash. The reality is going to be gold's making new highs. So I think the opportunities in the gold mining sector are incredible. And so for those who are seeking out those types of opportunities, they should really be looking at gold stocks. They could take a look at my fund as well.
Peter, do you have a view on U.S. small caps?
Yeah, U.S. small caps, look, small caps have had a pretty big run recently. Some people are hiding out in the small caps because they see the strong dollar and they recognize that, hey, this could have an impact on the multinationals, but not on the small caps because, most of their earnings or all their earnings are in the U.S., so it doesn't really matter what the dollar's exchange rate are. I think there's a lot of risk in a lot of these small companies. A lot of them have tremendous PEs, and I think a lot of them are going to be susceptible because I think when the dollar crashes, what's going to happen is a much higher cost of living for Americans. If we really have a big decline in the dollar, a reversal of what we have now, Americans are going to be spending a lot more money on food, on energy, on the basic necessities. They're not going to have as much money to shop And so I think the earnings of a lot of these small caps are going to be impaired. In fact, we're already seeing that now with the savings rate starting to rise, imports starting to come down. Americans are broke. They're loaded up with debt. They've got low-paying part-time jobs. The economy is going to have to adjust to a much poorer population, and the population is going to be even poorer once the dollar collapses. So I think that if you're in this small cap universe, you're going to have to be very careful about the types of companies you own. There might be some companies that can do well in this type of environment, but I think the vast majority are priced for a different type of environment that we're not going to experience.
Well, that may be true with the exception of the RedChip microcap, small cap stocks.
Well, of course, right? Yeah.
Now, Peter, finally, should we be buying defensive stocks? Should we be buying utilities, dividend stocks?
Well, I think you need to be defensive, but not maybe in the classic sense of what the typical Wall Street advisor would define as being defensive. I think you got to defend yourself from a collapse of the dollar, a bursting of the bond bubble, a massive U.S. recession, lots of inflation. And so I think when you understand what you're trying to protect yourself from, you're not going to have a cookie-cutter Wall Street strategy. I mean, we developed very unique strategies at my company, Euro Pacific Capital, to really try to be defensive against the real risks that are out there, because most people don't perceive these risks. They don't understand the problems. I mean, why was it that so many of the best Wall Street strategists and economists were completely blindsided by the 2008 financial crisis? It should have been obvious, but it wasn't. It was obvious to me because I understood the problem. And that's why so many people think the Fed solved the problem. They didn't. The Fed made the problem worse. But the people who didn't understand the problem don't know that, including the Fed. Because remember, the Federal Reserve, including Janet Yellen while she was on the Fed, was completely oblivious to the problems in the housing market and the looming financial crisis. She didn't know what was wrong with the economy in 2006 and 2007, and she still doesn't know what's wrong with the economy. Janet Yellen doesn't realize that it was the Fed's policy that inflated the housing bubble and caused the financial crisis, and she is pursuing the same policy today, only on a bigger scale. She is being more reckless than Alan Greenspan was. The problems that have been developing on her watch and that developed on Ben Bernanke's watch are far more extreme than what happened under Greenspan, and the consequences are going to be worse, particularly for investors who are not prepared.
They've created another bubble, no question. Peter, great being with you today. And my viewers, get his book, The Real Crash, and also visit his website there on the screen. You'll see it. And I think you gained a lot of wisdom from Peter Schiff. Peter, thanks for being with us today.
And thanks for hosting me.